Hello everyone, welcome to the live session of Quantitative Trading Strategies. So in this video, we're going to cover the implementation of the trend following strategy using Python. So remember that our data frame consists of the daily stock prices, which is the adjusted closing price, and the derived simple smoothing curves and the exponentially smooth the moving averages, right? So these are the derived series, also time series. Now, first we can identify the signal of the trend following strategy. So by signal here, we mean the position that we need to hold on to, depending on specific relationship between two series. So we have the time series, the simple moving average following a short window, and we have a longer window, right? So these two series will generate the signals, which again will be used to identify the trading actions. So specifically, our intended trading signal will be when there's a crossover, right? So when the shorts moving averages crosses the long moving average from below, right? So from below. So previously, so here is if it's more than so the short window is more than the longer window in terms of the average price, then we should need to hold a long position, right? That means that the stock itself has a longer momentum, it's a bigger momentum in short-term moving average. Otherwise, it's zero. So this is using the NP-well function to identify, to create a list of ones and zeros. And correspondingly, we need to identify the sell signals. So this is the opposite relationship. If the short term is lower than the longer term, then we put a value of -1. Otherwise, maintain as it is. We also remove the possible unnamed values in the data frame, and then we plot out the data. So this is the first few rows of the data frame, right? So it identifies the signal column, which takes the values of 0 or 1. And of course, if it's equal to each other, just in that case, it's 0, right? All right, so let's do a frequency count using the value counts function. And we see that most of the time, we need to hold the signal is -1, meaning that the stock itself has a bigger momentum to go down, right? And we do observe that in this period because it's not a good period and the market is going down overall. So that's the signal column we have. So in order to compare the strategy, we choose the buy and hold strategy as the baseline strategy to compare with, right? So in this case, we create a column called log returns for the buy and hold strategy. Buy and hold means that we're going to hold 1 unit of the assets and then hold it across the whole trading period. So in this case, we are using the adjusted close column, convert it to the log form. So we just log returns and then take the difference. So what happens is that we first convert it to the logarithmic form and then take the difference, means that the two quantities in log form, when they minus each other, is equivalent to dividing the original original adjusted closing prices and then take the logarithmic transformation. Right. So that's what we want to do here. And then after creating this column, we have the first few rows shown here. So this is the created price in log return form. All right. So that's the baseline log returns we want to compare with. Next, we calculate the instantaneous log return for the trend following strategy. So there's only one place we need to change, which is the direction of the returns, right? So this simple multiplication means that Now, if this log returns for the buy and hold strategy, right? So by default, if it's increasing, right? If it's positive, then if our signal is 1, that means that it is a profit for us. If it's -1, that means it's a loss for us, right? Similarly, if the stock price is going down, then this quantity will be negative. So if we are holding, we are loaning a stock that is 1, then this becomes a loss for us because we're holding a stock, then stock price is going down. And on the other hand, if the signal is -1, right, means we're shorting the stock, and by shorting the stock, the price goes down, then it's a profit for us. So this captures the final profit for each period using the trend following strategy, and we name it the log returns for the trend following. All right, so let's print out the first few rows, and we see that it's here, right? So that's the basic calculation scheme, and we can calculate the resulting trading actions. So this is how we draft actions based on the signal, right? So what happens is that we're just going to take the signal column and use the diff function. So the current period minus previous period in terms of the values of the signal, right? And then using the values counts to get the frequency counts. So here, most of the time, we just hold onto the position, do nothing. But there are 7 times we would go from a short position to a long position, right? It's going to be 1 minus the -1. And we're going from the long to short, meaning -1 minus 1, which is -3. All right, so that's how we derive the trading actions. So there are 7 times, 7 crossovers from short to long, 7 crossovers from long to short. So we can plot. So this becomes another column, another series in our data frame, which takes these different values, and we can plot it together in a graph here. So different lines represent different time series. So we have a long, we have a short. Actions represented by the triangles here. So, for example, here, if the orange line goes from top to bottom, right, there's a crossover, then we are going from a long position to a short position. So this is sell. And of course, this way of calculation assumes that we are able to close the long position and then go short at the same time. So that's the underlying assumption here. Similarly, for example, for this triangle, we initially are in a short position and then going to a long position. So that means that we're able to immediately close the current short position and go to a long position. All right, so with these 2 strategies, we can compare them in terms of the wealth curve. Right, so here we are visualizing the wealth curve. The way we do it is we take the log returns, convert it back to the normal returns, right? And now this normal returns is in the 1+R format. Then we take the cumulative product. So it's the same as if we were to first take the cumulative sum and then use the transformation. So these equivalent steps. And we do this for buy and hold and trend following. So here we have the evolution of the wealth curve using 2 strategies. And we'll see that the trend following is clearly better than the buy and hold. And of course, there are a few assumptions here, and there are different ways to calculate the. So if the assumptions change, then the wealth curve or the trend following will also change. So that's something we need to take note of. All right, so let's compare lastly the terminal return of both strategies. So here for the buy and hold, again, we first convert it to the normal 1+R, take the cumulative product and take the last value, and then convert it back to the simple returns. So this is the same for the trend following strategy. We see that again, the trend following is much better than the buy and hold strategy. All right, so that's it for this video, and thanks for watching.